Hello traders, welcome back to second video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools and community support to excel in the financial markets. Video part 1. We have divided this video in two parts for easy and convenient learnings. In this video, we are going to discuss in detail about currency pair analysis. Why detailed analysis is crucial for traders. Whether you are a beginner or an experienced trader, understanding currency pair is essential for making informed trading decisions. So let's get started. Basics of currency pairs. First of all, we will discuss how to read currency pairs. Many traders have hard time in reading and getting proper understanding in how to read the price correctly, so we will going to simplify it in this video. In the previous video also we have touched this point that in the forex market currencies are always traded in pairs. This means you are buying one currency while selling another. This first currency in the pair is called base currency and the second currency is quote currency. For example, in Euro USD pair, the euro is the base currency and the dollar is the quote currency. We have discussed this, and this is similar for all of the currency pairs available in the forex market. Now, for example, when you see a quote like Euro USD, so here 1.08316 you can see on this chart. It means that euro is worth $1.08. This is how you read currency pairs. It means whenever you want to buy 1 euro, then you have to pay 1.08 US dollars. Similarly, let's talk about New Zealand currency versus US dollar. So here you can see the price is 0.59. Alright. So whenever you want to buy a New Zealand, then you have to pay 59 cents for one currency of New Zealand. Now let's talk about ask and bid prices. The bid price is the price at which the market is willing to buy the base currency in exchange for the quote currency. On the other hand, the ask price is the price at which the market is willing to sell the base currency in exchange for the quote currency. This is USD INR ask and bid price chart. So on the left hand side you will find the bid price list, and on the right hand side you will find ask price list. Sometimes ask price also called as offer price. So do not get confused in this one. Here it shows that if you want to buy $1 US, then you have to pay 84.1475, and whenever you want to sell $1 US, then you will receive 84.1425 only. So there is a difference of 50 pips. In simple terms, bid price is what market buys the base currency for, and the ask price is what market sells you the base currency for. Alright, and base currency and quote currency, we are familiar with that concept. We have discussed it in detail in our previous video. The bid represents the demand and the ask represents supply for an asset. Now that 50 pips difference is called as spread. Alright, so let's look at what is spread and what is its importance. The difference between the bid and ask price is called spread. The spread is essentially the cost of trading, and it can change depending on the market condition, and also it depends on which currency pair you are trading. The spread varies from currency pair to another currency pair. Alright, here you can see the bid price means whenever you want to sell, then you will receive 917200, and if you want to buy, then you have to pay 91 rupees 0.7650. So there is a difference of 400 pips. So this difference is called as spread. So basic formula is there: ask price minus bid price will be your spread. When there is a smaller spread, it indicates that the market is more liquid. It have enough active traders participating in it, while a larger spread can indicate higher volatility or lower liquidity. The volume is very low if the spread is very high. The spread is the transaction cost for the traders. There is no brokerage in trading forex, but spread is there. Let's say you go to a phone shop and ask to buy a second-hand smartphone. He shows you a smartphone with a price tag of 20k. But if you tell him that you want to sell him the same phone with same condition, then he will tell you that the price he will buy you from will be only 17k. So there is a difference of 3k. Why? Because he has to deduct his operating expenses and also add a little bit of profit margin into it. In similar way, spread works as a transaction cost in the forex market. Forex broker are typically called as market makers. They buy at the bid price and sell at the ask price. And we are considered as price takers. We are not making a price, we are taking a price. Okay, we are following the market. But big players are the one who are moving the market. So that is why there is a spread which you have to pay that will gonna cover the cost for the broker. Let's see how spread works as a liquidity indicator. A smaller spread usually indicates a more liquid market with higher trading volume. Major currency pairs like Euro USD typically have very smaller spreads due to high liquidity. Conversely, exotic pairs might have larger spread due to lower liquidity. Very less people are trading those exotic pairs. So that is why the spread, the difference between ask and the bid will be very high. Let's see and understand the spread with a very simple example. Let's say we are trading Euro USD pair. So first of all, our initial setup is that we are buying at the price of 1.20. Okay, so for you to make money, the market must rise above 1.20 by 20 pips. Means for you to be even at break even, the price needs to be 1.2020. all right, so here you will not gonna losing anything, and also you will not gonna be making anything. So similarly, if you sell at the bid price of 1.1980, then the price must fall below 1.1960 for you to break even. Let's see what are the scenarios. If you are buying, then there are several levels of price at which what will be your profitability. At 1200 you have initiated your trade, but if price rises by the 10 pips, then you will be at a loss of 10 pips. And if the price rise by 20 pips, then you will gonna be break even. And if the price rises more, 10 more pips, then you will gonna be in a profit of 10 pips. Similarly, at 1.2040, you will gonna be in the profit of 20 pips. Okay, so in case of selling the Euro USD, if you are selling at 1.1980, then you will gonna break even at 1.1960 because your entry price is this one. But if you add 20 pips of spread into it, then the price needs to be falling below more than 20 pips for you to be in a profit. Alright, so this is how spread works in the forex market. I hope that spread section has been totally cleared. Now we are going to understand what is pips in forex. Pips is the unit of measurement to express the change in value between two currencies is called a pip. A pip is typically the smallest price movement in the exchange rate of a currency pair. A pip is usually the last decimal place of a price quote. Here you can see the price quote of Euro USD. Alright, so this last digit 6 is 6 pips. So when it rises by 10897, then you can say that the Euro USD has been risen up by 1 pip. Alright, and what is this 8? 8 is the pipette. This is the 1/10 of pip. So many brokers show pipettes also, and some brokers do not show the pipettes. Pipettes is 1/10 of this single pip. So I hope you are now familiar with the term of pip and will not get confused again while trading forex. Now let's see what are the importance of pips and how it can impact your forex trading. Measurement price movement. So pip are used in measuring that how much profit and loss you are in and how much movement a currency pair has done. So pips are used to measure the change in the value of a currency pair. They provide a standardized unit to quantify and compare the price movement. Then pips are used to calculate profit and loss. Trader uses pips to calculate their profit and loss. For example, if you buy Euro USD at 1.1050 and sell it at 1.1060, you have made a profit of 10 pips. So this is how you can calculate it. Alright, and there are some formulas to find out that how much money you are going to make when certain amount of pips move in your favor. So let's get into it. The value of pip depends on. So what does it mean? 1 pip in Euro USD. 1 pip in Euro USD is how much dollars or how much rupees it means. Alright, you have to calculate it. There are few factors that you need to consider in before calculating the pip value. First is which currency pair you are trading and the size of the trade, means what is the lot size of that particular currency pair and what is the exchange rate for that currency pair. So this is the simple formula that you need to put in while calculating 1 pip value. Pip value is equal to 1 pip divided by exchange rate into the trade size, or you can say lot size of a particular currency pair. Here, if you have bought the Euro USD at this price and the standard lot size for Euro USD is 1 lakh, then 1 pip will gonna be $9.05. So do you need to work all these maths? The answer is no. All of the pip calculations can be done by pip calculators, and on Thrive trading platform you can determine pip value of any currency pair with a few clicks. But knowing this particular formula and the rationale behind it will gonna understand and help you in taking crucial decisions. Understanding pip value is very crucial for risk management. It helps trader determine the potential profit or loss for each trade and set appropriate stop loss and take profit levels. Now let us understand the basic topic that most of the traders ignore, but it's very essential concept when you starts trading. Market order and limit orders in forex trading. Understanding these order types is crucial for executing trades effectively and flawlessly. In forex trading, placing the right order can make all the big differences. There are primarily two types of orders. The first one is market order and the second one is limit order. Each type of orders has its own advantages and is suited to different trading strategies. Let's start with market orders. A market order is an order to buy or sell a currency pair at the current market price. For example, you want to buy an apple and you go to the market. You found out that the current market price, the apples are selling for $10. Then you immediately buy it. Then it's a market order. This type of order guarantees execution but not the exact price. This type of order is used when you want to enter or exit a trade immediately on a blink of an eye. Market orders are ideal in only high liquid markets. Otherwise, you will gonna get very big slippages, means mismatch of price, or when you want to ensure that your trades should get executed quickly. As I said, there is guaranteed execution, but the price what you have desired may actually differ due to market volatility. Now let's talk about limit orders. A limit order is an order to buy or sell a currency pair at a specific price or a better price. Let's get back to the apple example. You go to the market, you found out that apples are selling for $10, but you want them at a bit better price. Let's say for $8 instead of 10, which is current market price. So for $8, you have to wait for the price to drop to that particular level. Then only you are going to buy it. So this is what limit order means. Limit order gets the best price, but execution is not guaranteed. In this Apple example, there is very few chances that on that particular time the price will gonna drop to $8 or not. If it did not get dropped to your desired level, then you will not gonna get apples, right? So limit orders are used when you want to enter or exit a trade at a specific price level. It's not always about buying at cheaper rates. When we are trading based on technical analysis, then it may require us to enter or exit if only certain price level is crossed. For example, when we are trading with breakout trading strategy, then we would need to enter only if price crosses the breakout level. So in that scenario, buying at current market price does not make any sense. So there, limit orders comes very useful. Let's take a live chart example. This is GBP USD chart on 15-minute time frame. It formed a very good ascending triangle like this, and at this particular point of time I was having a bullish breakout view, and if I had entered on that particular time with market order, then I would have made a very big loss here on my long positions. But here in this situation, trading with limit orders saved me from unnecessary loss. Similarly, on the second chart of GBP JPY on 15-minute time frame, earlier it was forming a very weak selling structure with many range bound candles here. After that weak selling, it has formed some kind of tight trading range, or you can say a base, and on that base entry is only confirmed when the actual breakout will happen. So here the limit order has triggered my entry and it moved very well to the upside. So after that I can use a market order at this point of time to exit my profitable position if I see the market is showing the signs of decline. In psychological aspect, limit order is a disciplined approach towards trading. These both are buying setup examples. Similarly, in selling setups also, limit order help you in taking only planned trades. Strategic use of these orders is, I would say, you should follow a dynamic plan for executing your trades, which involves using market orders plus limit orders according to the set of rules that you have created. Using market and limit orders strategically can enhance your trading in Forex market. Market orders will gonna help you react quickly to market movement, while limit orders will gonna allow you to plan trades at specific price levels. So I hope you have understood the difference between limit orders and market orders and when to use which order type while trading in the live market. That's all for the first part of this video. We will discuss some more advanced topic in the next part. Till now, in the first part of the video, we have discussed some important factors that you need to know before starting out Forex trading. Now, in the second part of this video, we are going to discuss what is currency correlation and what is its importance that you need to know before you dive into the Forex world. Let's get started. Understanding currency correlation is very important. So, what is correlation? Correlation refers to the relationship between the movements of different currency pairs, because some pairs move in tandem with each other and some pairs move exactly opposite to each other. There are some type of currency correlations that you need to understand. The first one is positive correlation, negative correlation, and zero correlation. There is no correlation between two currency pairs. Alright, so let's discuss these three kind of correlations in detail. When you trade multiple currency pairs at the same time, it is crucial to be aware of your risk exposure. You might think that you are spreading or diversifying your risk by trading different pairs, but many of them can move in the same direction. So that is not a hedging, that is magnifying the risk. Alright, to avoid this, you need to understand correlation step by step. So first, we are going to discuss positive correlation. When two currency pairs move in the same direction, they have positive correlation. For example, Euro USD versus New Zealand dollar USD. They both often exhibits positive correlation because they both involve US dollar as the quote currency. You can see both have USD as quote currency. Let me show you on the chart that how their price movement are pretty much similar to each other. You can see on this weekly chart of the Euro USD versus New Zealand US dollar. This is a weekly chart, so this shows a higher amount of data, so it becomes very easy and confirming that there is some kind of correlation or not. So we are seeing 2 years of data on these two charts. Okay, so Euro USD is falling initially. At the same time, New Zealand dollar is also falling. It means they have positive correlation. They both are moving together. They both marked this 10th of October 2022 as a bottom level, and similarly here New Zealand dollar also marked 10th of October as the bottom level in the price. And then recently a fall started from this top on 30th of September, which is also very similar, and all these different peaks and throughs are also marked at the same time zone, and the level of their fall is also similar, right? So they both possess positive correlation. By trading these highly correlated pairs, you are not hedging your risk, you are just magnifying it. Traders can use this information to confirm trends and hedge their position to a pair which is not positively correlated. So if you are long on Euro USD and if you want to hedge your position, you want to minimize your risk factor by hedging, then you should not choose New Zealand dollar as a hedging pair because they both are correlated positively, right? So this is not gonna help you in any way. Alright, so this is how positive correlation works. Now there are some pairs that typically moves in the same direction, like Euro USD and GBP USD, Euro USD and Australian dollar versus USD, Euro USD versus New Zealand dollar, USD chef versus USD JPY, AUD USD versus New Zealand USD. So these are the common pairs that have positive correlation in them. So that is why you would like to avoid trading when you are hedging your risk. I did some more examples to explain positive correlation. As you can see, Australian dollar and New Zealand dollar, they both have positive correlation. From the October month, you can see both have started a downtrend and they are moving on the downside similarly and very much in a synchronized way. So trading both on the purpose of diversifying the risk is not gonna fulfill here. And the next example is US dollar Swiss francs and US dollar Japanese yen. You can see both are in a bullish momentum, a biggest bullish bar in Swiss franc and similar big candle in Japanese yen too. So they both are forming an uptrend. So there is a positive correlation. Alright. So whenever you are taking a long trade in Swiss francs, then if you want a confirmation, then you can watch for Japanese yen, that if it is also in an uptrend, then your trade setup in Swiss francs is pretty much confirmed, or the probability of its up move will be very high, because they both are in synchronization. So you are taking confirmation. For confirmation purpose, both of the pair needs to be checked. Alright. But for diversifying, you need some negative correlated pairs. Let's talk about negative correlation. Negative will be just the opposite of positive. When one currency pair goes up, the other currency goes down. As an example, USD JPY versus Euro USD. When the US dollar strengthens, USD JPY often rises while Euro USD falls. So there is a negative correlation in between them. So these both can be used to minimize your risk factor while trading Forex. Let's see this chart on 1-day time frame. In July month, Euro USD was rising from this point, alright? But at the same time, USD JPY started to fall down. And in the mid-September here, Euro USD formed a top and started a downfall. But USD JPY formed a bottom and then started a new uptrend. So they both are negatively correlated. Traders use negative correlation to diversify their portfolios and manage the risk. If you are long on USD JPY, you might want to go short on the Euro USD to balance the potential losses. But let's say you want to check the confirmation that your long position is valid or not, then you can check for the positive correlated pairs. But if you want to hedge, you have to go for negatively correlated pairs. Some pairs which have negative correlation, they are Euro USD, USD CHF, GBP USD, USD JPY, USD CAD versus USD AUD USD, and USD JPY and AUD USD. These are some common currency pairs which have opposite direction movement. Okay, if one is going up, then the second one will be going down. So they are showing you a negative correlation. More examples in negatively correlated currency pairs are Canadian dollar versus and Australian dollar on day time frame. You can see from October, the Canadian dollar is rising relentlessly. They both are moving up and up and up. But the US dollar, Australian dollar is not rising, it's falling. It's very much opposite. They both are not synchronized. They both are highly negatively correlated. Okay, so fulfilling that hedging requirement will gonna be successful here. British pound and Swiss franc, they both are also negatively correlated. First one is falling, and similarly at the same time the second one is rising, right? So they are pretty much negatively correlated. So by understanding which pair is related positively or negatively with which pair, you can mitigate the risk a lot, and you can also take the confirmation for your trends. So correlations work in both ways. But if you are having good understanding on correlations, you will do well in the Forex markets. What is zero correlation? Zero correlation is not that much significant, but we will discuss it. That zero correlation means there is no correlation between two currency pairs. The price movement are independent of each other. There is no relationship between them. This phenomena is very rare in the forex market, but it can happen with the exotic currency pairs, or you can say the minor currency pairs may have zero correlation. So trading pairs with zero correlation do not provide any additional insight into price movement, but it can diversify your portfolio of trades that you have initiated. So what will be the practical approach while trading in forex with the help of correlation? You have to remember that correlations can change over time due to economic events. So never be solely dependent on correlation to initiate your trades. Use price action, different indicators, fundamental analysis, and then you should initiate your trades. So the practical approach is the step 1. Identify the first correlation, then manage your risk, then adjust your position. If you have been on the long side in multiple positively correlated pairs, then you might need to close some position and initiate negatively correlated setups to diversify your risk. So this is how you can use correlation as a practical application in the forex trading. There are some points to keep in mind while trading correlation is that dynamic correlations is there. Currency relationships can fluctuate over time due to change in market conditions, economic events, and central bank policies. Then variable strength. It is crucial to be aware of varying strength and direction, positive or negative, of the currency correlations. Correlations is not a causation, means it is not a trigger point for you to initiate a trade. Like there is correlation in USD, New Zealand and Euro USD, then it does not means that you go long in one pair if other pair is rising. This is not the right thing to do. You have to check other factors also, right? There are interest rate differentials can be there, so be mindful that changes in interest rate differentials can impact the currency correlations significantly. Sometimes the correlations can be out of place for weeks, right? So do not initiate or trades based on just the correlation. I am repeating this thing again and again. News event sensitivity. When there is some big news breaking out, then that can impact and that can disturb the correlation a little bit. Here is this example shows that how news can impact the correlations. You can see Euro versus US dollar was in a downtrend, but British pound versus Canadian dollar was in a uptrend. But suddenly in the last candle you can see they both have fallen a lot. The fall is very significant in both of them. So the negative correlation is disturbed here because of there are a lot of events and news datas are being published. So make sure you get aware with the news events and market updates. Market condition also matters. The nature of correlation can differ between trending market and a ranging market. Sometimes for few weeks one pair can be in a range and one pair will be trending, so the correlations can be out for few days or few weeks. So you need to keep all of these points in mind and then plan your trades. So continuous learning is very important in the forex trading. You need to stay updated with the evolving market conditions to maintain an accurate understanding of currency correlations. That's all for the currency correlation. I hope you understood how and when to use correlation and what are the points to keep in mind while using this concept in trading live market. We will be sharing regular updates on correlations, fundamental events and geopolitical shifts. So make sure to subscribe to our community channels to stay updated. The links is in the description box. Thanks for sticking around. If you found this video helpful, there is plenty more to come in our series on forex and technical analysis. And don't forget, for all your trading needs, visit thrive.com. For more in-depth trading education, head over to thrivehub.com. Thanks for watching. Happy trading, and I'll see you in the next video.